All right, welcome. My name is Mark Sebastian. I am the founder of Option Pit, and today we are going to start talking about VIX, all right, which is one of my favorite things to discuss. So here's the way we're going to do it. If something is extremely relevant to what I'm talking about, feel free to ask questions, all right? If you're interested in something but it's not directly relevant, all right, or you think of a question that is completely irrelevant that you want to ask me, save it to the end, all right? And so welcome. Again, my name is Mark Sebastian. I'm the founder of Option Pit. I was a floor trader for about 10 years. I do a bunch of consulting work for hedge funds. At Option Pit, we've dealt with clients that are trading 15 grand, and I've had clients that are trading, my biggest client manages about 15 billion. And some of my other clients, and I did a year consult for a firm that managed about $1 billion, and they were my fourth largest client. So that's a lot of fun. So we do education and trader education for retail and professionals, and then we do consulting at the firm level. So and then obviously I trade for myself, which is also fun. So that's me talking to Liz Clayman. She's my friend, and she's wearing 7-inch heels there. So it's not. I mean, I'm not a towering figure. I'm a notch below 5'9", but she was wearing 6-inch heels, and then it was funny. The camera would go off, and she just had a mouth like a truck driver. Wonderful lady, though. So here's what you're going to learn. You're going to learn what is the VIX, its intent, what makes it unique, how the VX future trades, the VIX future, how the VIX ETNs work, and then an option trade that I like to do on a semi-regular basis, and then I'll take some questions. So the VIX. The VIX is the CBOE Volatility Index. The purpose of the index is to gauge the buying and selling of options in the S&P 500. My friend Alex Jacobson likes to say it gauges the cost of insurance. All right? So the idea is that when there's more buying of options, which is buying of insurance, generally the market is trying to buy protection, buy insurance. All right? When there is more selling than buying of options, the market is out selling insurance. So basically, VIX up, cost of insurance up, and VIX down, cost of insurance is down. Really simple and a real easy way to look at it. All right, options are an insurance product. The VIX is an insurance gauge. Come on. All right, so similar to the S&P 500, the VIX index is not actually traded, right? There's no way to go out and say, buy me the S&P 500 index, all right? Now, you can buy futures on the index that expire into cash that track at an extremely high level. You can buy spiders, which track a little bit worse, but also track well. You can buy a basket of stocks, all right, that will track the S&P 500. But you can't just go out and say, buy me the S&P 500. All right? Everything has some sort of little management thingy. All right? It's not like buying stock where you just buy it, pay a commission, and you're done. All right? The VIX is essentially, and so one of the big differences, though, is that unlike the S&P 500, there really isn't a product that even tracks VIX all that, tracks VIX with a correlation of, into the 80%. All right? We're going to talk about this a little bit, but it's almost impossible to go out and just buy VIX. There's no way to do it. The closest that you can get is called a variance swap, and that's traded over the counter. All right? The other thing that you can do is to trade a strip of options in the S&P 500 that will essentially create VIX as well. All right, but that is it. And they're both very cost prohibitive, and really you can only do those in blocks of like 1,000,000 Vega. All right. So the VIX, VXX is not a good tracker of VIX. In fact, it is a terrible tracker of VIX. All right, and I'm going to show you that. All right. The VXX actually tries to track VIX futures, not VIX itself, and I'm going to talk about that. So, all right. The VIX is essentially an estimate of implied volatility on the S&P 500 that has a net duration of 30 days, a constant net duration. All right. So that constant net duration means that it attempts to constantly mimic a portfolio with 30 days to expire. So, you know, if you look at options on the S&P 500, right, you know, the November options have 3 days to expire. Well, 27 days ago, they had 30 days to expire. All right. Then over time, you know, the VIX is basically carrying two different option sets, and that's how it calculates itself. All right. And so it's constantly rolling options out of the front month and into the second month, and that creates a balanced portfolio that has a duration of 30 days. That's why it's so impossible to mimic, because there'd be so much day-to-day trading. All right. All right. If you're having some difficulties, try leaving and coming back, by the way. All right. So the commission costs and bid-ask spread of trying to do this constant balancing of VIX, because it uses so many options, all right, would just be completely prohibitive. All right. So the weighting of the VIX puts more emphasis on at-the-money options than those trading near the underlying. Emphasis, I obviously mean emphasis. All right. So the S&P closed 20.5. That is where the most is going to have the strongest effect on VIX, the volatility there. All right. Then the weighting of the VIX naturally puts more emphasis on out-of-the-money puts than out-of-the-money calls. So a put that is $50 out of the money versus a call that's $50 out of the money, that put is going to have more effect on the VIX than those $50 out of the money calls. All right. The VIX uses the two weekly options closest to 30 days to expiration. All right. One is equal to or less than 30 days, and one is more than equal to or less than 30 days. So if you were looking at this strip of options in the S&P 500, the VIX would use these two options. All right. So if I pull up my options now in SPX, I believe I would be using the December 12s and the December 20s. All right. And so those would be the two contracts I would be using, because these have 25 days and these have 32 days. Once these get to 23, we then roll back to these two, to the 20th and the 26th. All right, it doesn't use the quarterly. So those quarterlies do not get used. All right, the VIX is quoted as a price, but it is really a percentage. All right, it's like a batting average, if you will. All right. So volatility, despite not being spoken as a percent, is always a percent. All right. So a VIX of 14 is actually 14%. All right. So think about this. If you're a, let's say baseball. You're a baseball player, and your batting average goes from 250 to 275. All right. You get hot, start hitting the ball a little better. Your batting average rallies 25 points. Have you ever heard a baseball announcer say, Manny Ramirez's batting average is up 10% to 275? No, it's up 25 points, right? Does it ever make sense to describe a percentage movement in percentage terms? All right. Have you ever heard of somebody doing that? Only with VIX, and that's because people on TV don't know what they're talking about. All right? As soon as somebody says the VIX is up 10% today, you can immediately discount their option knowledge. They don't know anything. So now here is the VIX, the returns in the VIX versus the returns in the S&P 500. And this was up to October 1. And what do you notice? When the S&P sells off, VIX returns go up. When the S&P rallies, VIX returns drop. All right. So here's another view. On the left is the price of the S&P 500 and the blue line, and on the right is the prices of the VIX, and that represents the red line. And this gives you a real how the two can mirror each other. It's a really good view. All right, so this is actual price movement as opposed to returns. All right, and when the S&P is on its biggest sell-offs, the VIX is on its biggest rallies. When the S&P is on its big rallies, the VIX should be at its lows. One thing that is, I do think we're going to keep going higher, but one of the things that is kind of troubling to me, and I think this has to do with kind of a new volatility regime, is that the VIX is still hanging around 14 despite the S&P at 20.5. All right. So the VIX negatively correlates with SPX. So when SPX is up, VIX is generally down. When SPX is down, VIX is generally up. All right. This makes sense for multiple reasons. One, when the market sells off, volatility does increase. All right. And that's just naturally. All right. On top of that, there's the nature of similar movement against a lower number. Right. The S&P is moving $10 a day, and it's trading 2,000. That's 0.5% a day. All right. That would be a VIX of about 8. All right. If the S&P is trading 1,000 and it's moving $10 a day, then it's moving 1% a day. That is a volatility of about 16. All right. In addition, there are some features of VIX calculation that cause it to increase in a sell-off regardless of volatility. All right, so on one hand, when we sell off, volatility increases. On the other hand, there are some gadgets in VIX, or in its calculation, that actually cause it to naturally rise regardless. So the construction naturally causes VIX to rally when the market falls, and to fall when the market rallies. And it's caused by volatility skew. All right, now what is volatility skew? Well, think about it. The whole world is long, right? Everybody in the world is long, all right? CalPERS, PIMCO, you name it. All right? They're long. All right? Well, how do you protect a long position? Puts. All right? If everybody is buying puts, what is that going to do to demand? All right, it's going to push demand up. And then if everybody is, and then people say, well, I don't want to have to just buy these puts because it's going to kill my return. So what do? They sell calls to try and finance it. So that creates selling pressure on calls, which causes calls to fall. So you've got demand pressure pushing up puts and selling pressure pushing down calls. That creates skew. That causes volatility of calls to be lower than volatility of puts, which makes puts more expensive than calls. All right, so now let's say my at-the-money price is right here. Even if volatility doesn't increase, because at-the-money options have the greatest part of the VIX calculation, if I just slide down, because my weighting is gaining more on the at-the-monies, all right, I'm going to see the VIX rally, whether volatility goes up. I mean, I can remember regularly in 2009 and 2010, we'd see the VIX up and really implied vol was down. All right, now how can I tell if that the VIX is wrong? All right, well, if I own a bunch of options and I'm losing money on Vega, even though the VIX is up, that is how I know. All right? And, there's ways to see that. So when you can almost always see it in sell-offs, because what you'll look at is kind of this one more day of big selling, but the VIX won't react with it. That is usually a sign that sell-offs are over or coming to an end. All right. And I've done different write-ups and analysis for Kramer a couple of times. All right, so what makes VIX unique? If I asked you what the average price of the S&P 500 was going to be over the next 10 years, what would you answer? You make up a number. Now, if I asked you what the average price of the VIX is going to be over the next 10 years, what could you answer? And it's actually interesting. So for the S&P, the answer is your guess is as good as mine. Might be 3,000, might be 10,000. Who knows? For the VIX, the answer would be 20. All right? And how is this possible? Volatility is mean reverting. All right? This means that over time it hovers around an average. All right? For the S&P 500, that mean volatility hovers around 20%. The median mode is more around 17.5%. And I actually think that's a better level for what an average VIX is. And I'll tell you why. The VIX does not have an upper bound, so it can trade up to, in the financial crisis, it would have traded over 80. In 87, it would have traded well into the hundreds. All right? But volatility at its absolute lowest, how many days in total do you think the VIX has traded below 10%? Now, we've had some extremely low volatility times. What do you think? At least once a year. No. All right. Since going back to 1987, with back-tested data and live-tested data, the lowest the S&P 500 based VIX index had the number of times the S&P 500 VIX index have traded below 10 is a grand total of 9, and I believe 8 of them were in 2006. All right, so despite earlier this year, realized volatility in the S&P ground to a halt. Movement just stopped. I think it got below 4%, and the VIX was unable to break 10. So when you think about the lowest level the VIX is going to reach, 10% is that level. So now we've got an absolute floor of 10% and a limitless high. What is that going to do to what is that going to do to a mean price? Statisticians. When zero can't happen, what does that do? What does that do to how does that affect a data set in terms of its mean? Any guesses? It's going to skew it higher. It is going to skew the set higher. That's why 20 is actually an elevated VIX all the time. All right. And ask me that later. I will address that. All right. So I look at median and mode, kind of where the most occurrences take place. And that's around 17.5. So that's going to be your real average. The VIX has a limitless high. Theoretically, it could go to 1,000. All right. Like I said, they kind of interpolated a VIX in 1987. I think it was trading like 186 on. It would have traded 186. They were using OEX options, obviously. And then in the financial crisis, it got up to 87. And the question was, what is the highest the VIX can go? So it can go as high as it wants, but it's not going to drop below 10 for more than a week. So this presents trading opportunities in VIX, if one is so inclined. When VIX is above 17.5, it's eventually going to fall back. If it's below, it'll eventually rally. Now, it can take time, but having this knowledge of mean reversion is powerful. All right. So before I get into VIX futures, I want to talk to you about volatility levels. And VIX really trades in about 4 bands. All right. The band we're really coming out of was depressed volatility. And those typically take place in 2 to 3 year periods. All right. And those can be extremely long. All right. Then you'll have periods where we've got kind of low average volatility, and that's kind of where we are now. Then you'll have high above average volatility, and that's kind of when the VIX trades in the, the 18 to 25 range for a period of time. All right, or 18 to 30 range. And then you've got periods of extreme volatility. All right, and those are typically short, lasting about 6 months. All right. Ask me that if I don't address your question. All right. VIX futures represent 1,000 times the value of the VIX at expiration. All right. So if the VIX settles at 13.99, the VIX future is worth 1,000 times 13.99. All right. They expire monthly on the Wednesday that is 30 days prior to the next month's settlement. All right. So if you think that's confusing, you're right. All right. Basically, 8 months a year, the VIX is going to settle the Wednesday before expiration, and 4 months a year, it's going to settle the Wednesday after expiration. Leap years will throw that off a little bit, but generally, if it's a 5 week cycle, it's going to have then that VIX future will settle. If the coming cycle is 5 weeks, the VIX future will settle on the Wednesday after. If the coming cycle is 4 weeks, then the VIX future will settle the Wednesday before. So December is going to settle the Wednesday before. So will January. All right. November, also, I believe. Yeah. We're settling, we're settling tomorrow morning. All right. They expire into cash based on a special opening rotation. A bunch of trades go up. And now, this is important. They're, best of my knowledge, they're the only cash-settled future that is what's it called? No, that's not true. S&P 500 are European. So anyway, they're European, which is there's no early exercise. And that's important, all right, that there is no European exercise, or that there's no early exercise, and I'll tell you why. Because it creates a contango, all right? So imagine this. You're holding a VIX future with 30 days to expire, all right? And you know volatility mean reverts, and the VIX is trading 12, all right? Do you think the VIX is going to be trading at the VIX future will be trading below 12 or above 12 or trading at 12? Well, it's going to be trading above 12. That's the answer. So, for instance, right now the VIX is around 13.87, I believe it's settled, and the December future is trading 15.2. All right? So, and that is contango. Contango is a market condition where back month futures are more expensive than front month futures. When VIX futures are in contango, it represents that the market is more afraid of long-term market risk than immediate market risk. VIX cash is below the futures price. Long-term expectations are that the VIX is going to rise. VIX is in contango over 80% of the time. All right, so it's almost always in contango. So this is VIX. This is a VIX curve. That is contango. So now backwardation. Backwardation is a market condition where front month futures are more expensive than back month futures. When VIX futures are in backwardation, it represents that the fear of volatility in the near term outweighs fear in the long term. VIX futures are trading below the cash. And that means the market believes that over time volatility in S&P 500 options is going to fall. This is the curve on 9/30, 2011, a couple years old. Yeah. All right, so VIX decay. So now you've got the future trading at a premium, and you've got the cash trading below it. So as time passes, traders using VIX to hedge have to deal with the convergence of VIX futures to cash. In contango, that is a huge drag on a portfolio. All right. In backwardation, this will actually put a tailwind behind a futures contract. Again, contango backwardation rate is about 4 or 5 to 1. All right. So over time, so the November future, think about this, the November future traded into the 20s. All right? And then tomorrow, assuming the VIX settles here, it will trade like 13 something. And I believe it closed around 14.20. So if the VIX future if the VIX cash is 1380 and the VIX November future settled 14.20 today, tomorrow on the open, those two need to converge to each other because they're going to settle. So over time, contango, this spread between cash and the future tightens to almost nothing the day before expiration. All right, so that's a big thing to understand on futures when you're trading them and looking at them. All right, so now let's talk about the volatility ETNs. All right, and these are for the in terms of hedges. These are one of the greatest exercises in futility I've ever seen. All right, as trading in the VIX futures have become more and more actively traded, each of the ETNs have been created with a stated purpose. However, due to term structures of VIX futures, many ETNs have some unintended consequences. Now, they say it in the perspective, but a lot of people don't know this. So VXX, let's talk about VXX, all right, or the iPath S&P 500 short-term future ETN. It attempts to replicate being long VIX futures with a constant duration of 30 days. So instead of, the VIX has a constant duration of 30 days. So they said to themselves, hey, you know what, it makes sense to have a future with a constant duration of 30 days too. So the intent of the fund is to allow traders to get long or short near-dated forward volatility in an ETN. So what the fund does, it does this by constantly rolling out of the front month future and into the second month future. So we all know who King Sisyphus is? All right. Sisyphus was made to endlessly roll a huge boulder up a steep hill, all right, because he thought he was more clever than Zeus. The maddening nature of the punishment was reserved for King Sisyphus due to his hubristic belief that his cleverness surpassed that of Zeus. Zeus accordingly displayed his own cleverness by enchanting the boulder to roll into rolling away from Sisyphus before he reached the top, which ended up consigning Sisyphus to an eternity of useless efforts and unending frustration. Thus, it came to pass that pointless or intermediate activities are sometimes described as Sisyphean. All right? And that is what VXX is doing to itself. All right? It has what I like to call the Sisyphus effect. Yeah, it will be recorded. It has been recorded and will be sent out. Yeah, I like to I like to give people a lot of knowledge. I'm a proponent of knowledge. So, all right, in a contango state, the VXX is constantly rolling the boulder up the hill and then letting it go and then riding the boulder down. All right, so it is constantly buying futures, riding them down to cash, only to sell them at the bottom and buy a new future out the top. This creates a major problem for the ETN because it is constantly selling a less expensive future and buying a more expensive future. The ETN has a limited amount of funds. When VIX futures are in contango, funds are being depleted. So thus, all right, so would you run a business where you bought a product for $16.10 and sold it at $15.50? What do you think? Would you do that? No. Well, that's what the VXX does, and that's why its P&L chart looks like this. And actually, this is old. It's done another split since then, or two splits. No, just one. So, do you guys know what what I believe the opening price, split adjusted price is for the VXX from its initial offering? I believe it's about I want to say it's about $7,000, maybe like $7,800. Let me look. I always forget. I always forget. Well, now the thing to remember is that intraday. So in terms of just trading from in the morning until the night. It's it was 6,500. I'm sorry. If I think volatility is going to go up today, have at it, all right? Or if futures are, for some odd reason, in a backward state, the product can work really well for short periods of time. All right, so VXX is slowly rolling itself to zero. It should not be held for more than a few hours if VIX futures are in contango. So you can day trade VXX. And in fact, VXX typically leads SPY in movement. So you'll see VXX rally before you see SPY and vice versa. All right? It's a great volatility day trading product. And it also can be used as a hedge against falling volatility. All right? It's just a poor hedge against rising. All right, so now, VXE is midterm, and that's optionable, and that's okay. All right, I believe is not reverse split yet. Then you've got UVXY, which is the double long and levered. If you think VXX is bad, UVXY makes VXX look like a super profitable product. It's so bad. UVXY and TVIX are impossible to own for more than a couple of minutes. All right. Now, in terms of a hedge, XVZ is probably the best. It runs like a little bit of a contango yield trade, and then owns some long-term, a long-term reverse trade. It's a little convoluted, but it doesn't have the volume, unfortunately. All right. Now, the inverse ETNs are interesting. So you've got the XIV, which is the reverse VXX, which is great. Now, ZIV actually does fine and is much more stable. So if you're a person that can't really handle, the fact that XIV can lose 10, 15, can lose $15 and over a couple of days, take a look at ZIV for, ZIV is the inverse of VXZ, and it's actually a very consistent and has performed pretty well. All right. Then there's SVXY, which is also similar to XIV, but it has options. XIV itself does not. All right, so now I'm just going to give you one option trade that I like to do in VIX. All right. And this is kind of as opposed to doing a put credit spread. All right. So again, remember that the VIX, remember we talked about that absolute lower bound? All right. So that it's only been below 10 a handful of times. So here's a trade that I like to do when IV is moderately high, and I think VX is going to fall. But I'm not sure. I do a bear 1x2. So I actually did this trade in October, and it came out profitably. All right. I bought an October, and I thought vol was going to fall, and I was wrong. All right, and I made money. All right, so with VIX around 14.5, and my belief that VIX was going to fall, I bought 10 of the October 13.5 puts for 55 cents. I then put an offer out, and I sold 20 of the 13 puts at 35 for a net credit of 15 cents. So net I bought the 1x2 for a nickel. Or a net I bought the 1x2 for a 15 credit. So here's what the P&L zone looked like. So above 13.5, I just kept my credit. All right. Below 12.35, I could lose money. All right. But if it fell into my profit zone, which is really the big part of its trading range over the last 6 months, I could do really well. I could do really well. And so this, I like this as a bull and bear trade far better than selling like a put spread in VIX. Now, if you're saying, Mark, what about the margin? Go out and buy like a nickel put, and that'll take care of the margin, and you just don't ever get rid of it. And so the idea is, there are a lot of nuances to this trade, but the key is I have a lower bound of the trade that makes it more favorable. So while a lot of people look at the margin and say, well, you could theoretically lose a lot of money. Well, no, I theoretically can't, because all the VIX can really go to is maybe 10, 10.5, 11. Whereas that profit zone, I could really do well. So the idea is, the VIX future slowly creeps and lands in my profit zone. There aren't that many traded options traded on OEX anymore. In fact, almost nobody trades it. So we are going to cover this this trade and many other trades in a course I'm going to offer with my offer. All right. So in summary, VIX is unique. It's based on the S&P 500. It's mean reverting. The futures are not the cash VIX. Most of the VIX ETNs are awful for hedging, and I like bear trades. So the option pit bootcamp. Oop, date's wrong. Sorry, guys. I do this about once a quarter. So it is going to start on December 9th. All right. So the option pit bootcamp, you're going to engage in the wheel trade, and that's a trade that I do that involves selling puts, buying stock, selling calls, collecting dividends. All right. It's a great IRA trade. All right. And then you're going to learn how to increase profitability of directional trades. All right. Then you're going to learn to manage trades and maximize profits. You're going to learn directional and non-directional trading. And you're going to learn how to manage a book. All right. This is my hardcore boot camp to get people ready for my gold class. All right. Now, in addition, and normally we charge $400 for this, and I'm charging $147. All right. In addition, just for you guys, all right, this is the last time I'm doing this intro to VIX class for the next 2 months. All right. I'm going to be rolling out, I kind of do a roll through one webinar for 1 month, then another one for a month, then another one for a month. And so I'm not doing this one for 2 or 3 months. So I'm not going to be making this offer to anybody else. Enroll between now, all right, and Thanksgiving. The boot camp is going to be 4 days, all right, and each session is going to be an hour and a half plus a half hour for questions, all right? And if you enroll now, between now and Thanksgiving, I will send you the VIX primer, all right, that we did about in October, which is a 3-hour course where I just dug into VIX, me and Andrew. Andrew spent an hour and a half just eviscerating the ETNs, going through all sorts of smart trading techniques. And then I went through the VIX options and really dug into how to trade them properly. All right? All right, so I'm going to give that to you for free if you sign up for the VIX, if you sign up for my boot camp beginning December 9th for $147. So you're basically getting like $550 worth of content for $147. It's not a bad deal. Go to optionpit.com/bootcamp to register. All right. So questions? I know I went through a lot. Questions, comments, thoughts? Okay, well, if nobody's got questions, I will send the recording out sometime tonight. Oh, basically, what is the best way to hedge a portfolio? All right. The best way to hedge a portfolio, there are different arguments for it, and it really depends on what kind of portfolio you're dealing with. If you're dealing with something that's kind of constantly in cash, or is constantly in the S&P 500, then, you know, things like, you know, so it depends whether you're more interested in wealth preservation or wealth growth. All right. So if you're trying to grow, I would approach the hedge in one way. I would probably use VIX or like a LEAP. If you're trying for wealth preservation, then I would probably use like a shorter term collar or backward or back ratio, something like that in a in S&P 500. All right. My view on VXX versus VIXY. You know, VIXY's not one I follow as much, but my understanding is they're pretty similar, aren't they? What kind of returns do I expect? I mean, on what? That doesn't really, I'm really not sure what. Does one have to be proficient with options to take the boot camp? No, it's actually designed for people that aren't. So please explain backwardation. Backwardation is when the cash VIX and VIX and short-term VIX futures are trading at a premium to long-term VIX futures. You know, and that is backwardation. All right. So what kind of returns do you expect from using your strategies? Does this work for a $5,000 or $10,000 account? We actually put out a strategy letter at Option Pit that risk adjusted does pretty nicely, and I have to look at and see. It's designed around a $15,000 portfolio. So we actually design our trades for kind of the smaller trades. So if you're looking for wealth growth, I'd be more inclined to hedge using kind of a longer term option or a long back spread. If volatility really ramps up, why would UVXY be a bad vehicle to be long? No, if volatility really ramps up, yeah. But the problem is while you're waiting for volatility to ramp up, the thing is going to reverse split 6 times. And on the ramp up, you won't make any money. All right, you legitimately, you are better off sitting there waiting for volatility to begin to move higher and then buying UVXY. It's not worth owning as a hedge. What's the counterparty risk? There shouldn't be any counterparty risk on these. They're all OCC, Option Clearing Corporation backed. Could you use actual numbers rather than just a theoretical explanation? For backwardation? Sure. Here, let's go to VIX Central and I'll show you. So here's obviously contango, and here's where everything's settled. So we'll look at historical prices, and here is October 16th, 2008. And you can actually see the VIX cash, or the VIX future, settled 63.88. The no future settled 42.78. Here's the DECE, Jan, Feb, March, and so this is backwardation. Does that make sense? No, this is backwardation because the front month's over here. All right, this is the near-dated stuff. This is the long-dated stuff. You got to look at this thing backward. And then a contango chart looks like this. See, this is Nov, this is June. So we move this way. I know it's weird. We're moved from right to left, so it's like reading Hebrew. That's all right. Any other questions? Yes, VIX is mean reverting. That is correct. But again, I think 17.5 is more the mean than 20. I think that's a misrepresentation. Well, mean reverting means over long periods of time, the VIX will come back to 17.5. All right. You know, it'll spend a couple. Think about this. So it spent, you know, 04, 05, 06. You know, around between 10 and 14. Then it spent all of 08. You know, it spent a huge portion of 08 and 09 above 30. Is there options on VIX? Yes, the symbol is VIX. VIX. All right. Remember, you can go to optionpit.com/bootcamp, take that special offer, and I'll have that VIX primer to send out to you tonight. All right. Any other questions, comments, thoughts? All right, everybody. Have a great evening. I will talk to you soon.